Good afternoon, everyone. Thank you very much for joining me. This is our last ad hoc webinar for 2019. It's titled Mistakes Made by Traders, and I think that we are all susceptible to these. Now, to present this type of webinar is actually fairly challenging because in our previous webinars, we referred to charts and we referred to um, instruments, and we really unpacked it as a unit, and it really maintained, I think, the interest amongst us as we went through the subject matter. This webinar is a little different. It's to be honest with you, it's not. It's roughly about 19 slides, but with the disclaimers, perhaps about 17 slides. But it's very, very dry, as in that there is no charts, because we're not really doing any sort of analysis here. What we're doing is we're really having a discussion, and I think that if we can uh, continue this as a two-way discussion between us, and if there's any comments or any points that you guys want to debate, I want to encourage it, because it will make it very, very interesting. Because in truth, I think the subject matter is tremendously important. So with that introduction, I'm going to try and ask questions, and if I can just ask you to participate. Remember, there's no right or wrong answers here. At the end of the day, we're all going to put on our trades. We're all going to try our best to manage the trades, and we're all going to try our best to make money. And I think that the points that I have put together in this slide are perhaps not even all of the mistakes that traders make. So if you want to introduce others, please go ahead and do that. As I say, we all learn off each other. So let me just introduce myself. I'm sure you all know I'm Russell Shaw. I'm the Senior Market Specialist at FXCM. And the email to reach me is rshaw@fxcm.com. Today being Friday, the 13th of December, and I'm going to just bring up our disclaimers. I'm just going to keep these on screen for a few moments, and then we're going to go right into it. All right, just another 2-3 seconds just to keep this one up. All right, and we'll just put up the market commentaries disclaimer. Okay. Alrighty, let's get into it. All right, so this is slide 1. And again, I want to promote openness and discussion. I think that's where we will get the most out of this. And the first thing I'd like to say and start the whole webinar off is, what type of trader are you? Okay, what type of trader are you? Okay, Paresh. Okay, no worries. Okay, no worries. So let us think about this question. What type of trader are you? So what I'm essentially asking you is, how do you define yourself as a trader? So Richard writes that he's a swing trader, and that's important, because the type of trader, yeah, Paresh says he's a day trader. Aline says, Eileen, there is a recording. This webinar, all the webinars are recorded. So yes, Eileen, if anybody that wants a recording after this, you just send me an email. You know, Boniface says that he's a day trader, and the truth of the matter is, this is where this type of question comes in, right? We can be scalpers, day traders, positional traders. I should have put swing trader in here. I didn't put swing trader. But the point is, each type of trading is going to have its own particular challenge. And it's also going to have its own particular rule set. Okay, it's going to be it's going to have its own particular rule set. Now that's very, very important, because what tends to happen, and I've done it many times myself, is I would go into a position thinking, okay, I'm going to just scalp 10 pips off this, in, out, and then I'm going to move on. And the truth of the matter is, when I go into a position and I'm looking to scalp it and it moves against me, I change the definition of the type of trader. Okay, I'm not a scalper. I'm not a scalper. This is actually a day trade. I'm going to give it a little bit of room to move. It should come back in my into my sort of position, and if it carries on going down, then I'm no longer a day trader. I become the swing trader. And the point is, before you even put on a position, we've got to really understand what type of a trader we are, and when we've made that choice, okay, when we've made that choice, and there's no right or wrong answer here, by the way. You trade according to your particular trading personality, and we're all very, very different. Some of us have a higher tolerance for risk, some of us are more risk averse, and that's fine. Some of us go headlong seeking into risk, some of us don't like it at all. And risk seeking, you know what that means? It means high risk, high reward. High risk, high reward. So there's no correct way to do this. Skulk says he's a trend trader. Shadrach says he's a day trader and scalps. So the point is that we've got to know what type of a trader we are. And when we define the type of trader we are, is it honestly lining up with our trading psychology? Okay, because you're going to see that there's a particular it's actually an Australian trader by the name of Nick Raj calls the beginner cycle. The beginner cycle, and what the beginner cycle is, once we decide what type of trader we are, we start playing around with different strategies that are particular to that definition. So if I am, say, a day trader, there might be a system that I settle on, and I decide I'm going to, it's a very well-known day trading system, and I start trading it, and I'm not particularly successful with it. Okay, so that's system A. And then what tends to happen is, after a few trades running with strategy A, we've now gone into loss, and we decide, this strategy A actually doesn't work. Whoever wrote the reviews for the system, or whoever gave me the system, they don't know what they're talking about. I'm going to jump onto this other system, which I've just found, which is called system B, and I'm going to start trading that. And what tends to happen is, you'll see a lot of the topics that I'm speaking about recur throughout this presentation. So system chasing is one of them. But what happens is, when we define what type of trader we are, and we find out that we are not being as successful as we would like, we either change the definition of what type of trader we are. In other words, instead of being a short-term trader, we now become medium-term or longer-term. And we also start hopping between these different systems. And there's an inherent problem with that. There's an inherent problem with that, in that what happens is that if we're talking about system A, we may be trading system A whilst it's going into what we call its markdown period. Okay, it's going down into its markdown period. In fact, anybody that's using system A at this particular stage will probably have some losses, because according to its rules, the market, the character of the market at this particular time is not aligned with the system settings and requirements, and it goes into a markdown. And what we tend to do as traders is, well, we decide we're going to hop into system B just at the time when the market conditions are starting to line up with system A's parameters. So just as system A's markdown period is about to end, just as it's about to move into its mark up phase, we've just bailed on it, and we've just jumped onto system B, and it may be that we're jumping into system B when system B's parameters are not lining up with the current market conditions, and we find that we're just not having any luck in the market. And the truth of the matter is, we all go through this. We all go through this. And again, I want to just reiterate, we're gonna talk at about system chasing later in the presentation, but the whole idea is that when we've defined ourselves as a trader, I think we've got to be true to that definition. We've also got to be very honest with ourselves if we are in fact that type of a trader. I know for a fact I'm not a scalper. I know I'm not a scalper. I mean, when we trade non-farm payrolls, we're trying to do a scalp then. But truth be told, I find it very pressurizing. After I finish the call, once we've done a non-farm payroll, I actually got to sort of go to the bathroom, just splash a little bit of water on my forehead, which is a little clammy, because I'm stressing. It's just because when I put on a position, I don't want to. I generally, whilst I do have my monitors up around me, and perhaps I'm fortunate that way, it's probably some of my best trades are probably when I'm not in front of the monitor, and so I recognize that that's the type of trader I am. So the first thing we've got to understand is what type of trader are we honestly, and can we maintain the requirements to be that type of a trader? If you say that you're a scalper, okay, are you truly a scalper? Because a scalper is in, out, in, out, in, out the whole day. A scalper is just taking a little bit here, a little bit there, a little bit more over here. And by the end of the day, they've accumulated quite a bit. But it's a very specific skill set. It's one that I don't have. So if you do have that type of a skill set, then that's fine. But if you're a scalper, what I'm trying to say is one needs to respect the requirements of a scalper. When you know that your scalp is not working out, the scalper doesn't even think twice. Boom, he is or she is out of that trade almost as soon as they recognize that they are wrong. It's a very good skill to have if you can recognize that you're on the wrong side of the trade, and boom, you're out. So that's the first thing I want to mention. And I'm just talking when I first started trading, I'd put on a position, it would go against me, and I'd say, well, I'm definitely right, the market's wrong, and I'd hold on. And that's because I hadn't really defined what type of a trader I am. Does that resonate with any one of you guys? Be very interested to find out. Okay, yeah, a few guys saying it certainly does. All right, let's go through. Yeah, let's go through to the next one. Okay, the next one is correct expectations, and it's, are our expectations aligned with reality? Do we really understand what is realistic from the market? Let me just see here. So Paresh is yes, Lee's yes, Richard says yes, that he can be a scalper, but would rather do what suits his pleasure and plans. Skulk, I've tried scalping, but not successfully. Okay, so I mean, and I'm exactly in that same situation. So the question I ask, and this is for me tremendously important because I've got I guess the honor of actually speaking to guys from South Africa. I've got the honor of speaking to guys from the UK. I've got the honor of speaking to guys from Australia, and the idea here, is, are our expectations aligned with reality? And I'm just talking perhaps, and you guys can correct me if I'm wrong. I often find that it is us as South Africans that generally are not really aligned with expectations. And I think the reason for that, one of the reasons, I think, is because previously, South Africans, not all South Africans, were entitled to participate. Okay, and it's now that we have we've got a democracy. Everyone's entitled to participate, and the idea is that perhaps the brokers and brokerages are promoting incorrect information when it comes to what are the realities with what the market can give, and is that aligned with expectations. And I think that often when guys come in and we're sitting and talking, um, new clients come in, they have a smaller trading capital, that it's a suboptimal trading capital. And this is again another subject which we are going to be speaking about in a moment. And the expectations with that capital are completely out of whack. Completely out of whack. The truth of the matter is that trading in reality can be exceptionally lucrative. It can be exceptionally lucrative, but it can be exceptionally punishing as well. And that's the reality. And the question is, are our expectations aligned with that reality? Let me see a couple of questions here. So Ndumiso says no. I'm assuming, Ndumiso, you're saying that is your expectation is not aligned with the reality. Is that what you're saying? Richard writes, also scalping is mainly momentum and does not have a robust passive income system. Yes, exactly. Exactly. So what I think you're saying there, Richard, is you also enjoy having positions where you're earning an overnight interest, if I read you correctly. So what I'm suggesting with correct expectations is that we all, and I promise you, I count myself, is we all want to make money quick. It's our get rich quick mentality. When I first started trading, that was the serious way that I thought about the markets, is that I'm coming to the markets and I'm going to try and ramp up my trading account as quickly as I possibly can. And it was completely uh, unaligned with reality. Okay. And the market is going to give you what it's going to give you. Okay. It's not going, you can't force the market to give you pips. If you're on the wrong side, you're on the wrong side. And I know that we all want to make money quick, because I promise you, I've been there. And the problem, okay, the problem with wanting to make money uh, as quick as possible is it leads to a whole host of problems that as traders we have to deal with, and we often don't recognize that we are sort of behaving badly. What do I mean by that? Well, it means that if you have incorrect expectations with the market, okay, and again, I'm talking from personal experience here. If I look at the market and there's no opportunities to trade, well, I force a trade. I look all around. Where can I put my money? Or I don't do this anymore, but it certainly is something that I did in the beginning. I chased the market. I looked for taking a trade where I thought there may be a setup. The setup hadn't quite completed yet. It hadn't quite completed yet. And then I thought, well, it's definitely going to complete. I'm going to take it now. And it led to a whole host of problems for me, because not only was I not aligned with reality, I wasn't making money, let alone making money quick. I was on the wrong side of the trade more often than not. Okay, so the idea here is when we come to the market, yes, it can be lucrative, but we want to be absolutely uh, real about it. In recent recent market trading, so I'm talking over 2019, I had a terrific first 6 months. Terrific. The last 6 months I have struggled, not in that there have been big losses. I've struggled to get the equity curve moving. It's moving up, then it moves down, moves up, moves down. It's a much more staccato sideways type of movement within the first 6 months. Is just the way that my trading has gone. So that's the idea. You got to align with what the market is willing to give you. I've missed some good opportunities, and I'm sure that there's a lot of you out there that have made some great trades. So if anyone was trading cable since the beginning of October, you would be sitting absolutely pretty at the moment. It's been the most wonderful instrument to have been trading. I wasn't lucky enough to get on those. So it's very, very interesting that you've got to have the right expectations. And when you have the right expectations, you won't force a trade. You won't chase the market. Very, very important. Let me see some comments here. Richard says he looks for systems which require very little amount of time and effort, so he can do more important things while his money is growing. Passive income for Richard is not trading one's time for money, salaries, and wages. Skulk says, I am one of those very impulsive and it's costing me. Exactly. So we have to have patience, which is what we're going to talk about next. When we talk about correct expectations, we've also got to understand that we're not going to be immune from having losses. If we are choosing to be traders, and we're going to talk about this so many times, okay, so many times we're going to be talking about this over the next few slides, but the whole idea here is we're not going to be immune from losses, and we have to be comfortable with that. If we are uncomfortable with having losses, you know what, then what happens is we change our definition. We're no longer a scalper. You know what, then we're a swing trader. But then the swing's not working in our favor, so we become a positional trader. So we've got to understand that losses is a part of this business. It's the same as in any business. Any business is going to have a business expense. As traders, a trading loss is our business expense, or one of our business expenses. That's fine. Okay, as long as the equity curve is moving in a northeasterly direction over time. Okay. Skulk, this may resonate with you. Patience, right? Traders are often impatient. I am very, very impatient. It's one of my I guess worst qualities. My impatience. I hate standing in queues, but when it comes to trading, again, I'm desperate to have a position on. But the truth of the matter is, when there's no setups per our system, okay, if we're impatient, we start looking for setups that are not part of our system, which comes right back to the very first slide. What type of trader are you? Define yourself. If you are a swing trader and there's no swings, that's fine. You don't have to trade. If you are a scalper and there's no scalps, don't have to trade. Okay? Because the problem here is, if we're impatient, if we lack patience, you know what happens? We start forcing the trades. They don't fit into our system. And I've done this many times. I've done it in 2019. And I think that it's very difficult to maintain a patience as a trader. But it's terribly, terribly important to maintain a patience. Okay? Because if we lack patience, it's going to lead us to forced trades. Richard says that he's in very long swing trades, still from early last month. That's phenomenal. He's paying overnight swaps, but earning swaps on the other majors. Okay. And so lack of patience leads to us forcing trades. And this is what's also the truth for us. Okay, is that we don't have to trade every single signal. we've got to sleep, for goodness sake. You know, there's going to be signals in the Asian session whilst we're sleeping, and we're going to wake up and they're going to have been extremely profitable signals, and we've missed them. But that's just a part of the business. The truth of the matter is we don't have to be in all the moves, but we still need to follow our system. We need to follow our system. So it comes back, you define what kind of a trader you are. You understand that every system is susceptible to losses. You have to be comfortable with the fact that every system is going to have losses. And you also got to recognize that you don't have to be in all the moves, and you don't have to manufacture setups if there's no setups there. You want to really try and get into the high quality as opposed to the quantity of trades. You want to try and get into the high quality versus the quantity of trades. Any comments around what we've said so far? Look at yesterday's pound US dollar candle designed to kick traders out of the pound sterling, and look how it's shaping out today. Yeah, totally. And I think that comes down to exactly, I was about to say this. So Richard says you need to be resilient and you need to stick to your plan. Now, a trading plan is one of the slides. A trading plan is one of the slides we talk about, but more than that, we actually had an ad hoc webinar a couple of months back talking about the need of a trading plan. But we'll talk about that as we get into that slide. Skulk says, I am looking for the correct signals and what to use as indicators. Okay, cool. I think, Skulk, hold off perhaps on that thought till the end and see, maybe we would have addressed it, maybe we would not have addressed it. So if we haven't, just bring that up again. Michael says, my system aligns with positional trading. Yeah, I prefer a positional trading. I prefer a positional trade, exactly, Michael. But we're also going to talk about that. You see, every one of us on this webinar has a complete unique trading psychology. And whilst we're all traders and we can all speak a similar language and we all know what it's like to be involved in trades, and we can empathize with each other, we can't trade for each other. We can't trade for each other because we've all got very different needs. And it comes back to our first slide. I can try and scalp to the best of my ability. It's very difficult for me. It hurts my brain, it hurts my psychology, because it's so quick. It's so quick. I'll read what Richard says here. Ichimoku was presented here as an excellent system. Can make thousands of pips with Ichimoku provided one takes trending pairs and takes care not to be chopped up. Okay. So Ichimoku, I haven't used Ichimoku myself. I'll tell you the reason why I haven't used Ichimoku, not because I don't think it's a good system. I don't know very much about it. So when I did my first course in technical analysis, so I did my course through the Australian Technical Analyst Association, which was really a good course. I did it many years ago. I did it like, I think, early 2000s. And Ichimoku wasn't really a known system then, so it just wasn't part of the coursework. So I never really got around to learning Ichimoku, although I have read articles on it since then. But the truth is that it's not a system I'm particularly comfortable with, not because I don't think it's any good. I just never really sat down and studied it. But when I have seen Ichimoku, I think that it's fairly similar. I think it's fairly similar to the zone analysis, which we use a lot of. But it doesn't surprise me. Okay, it doesn't surprise me. If you're trading a trend, if you're a trend trader, and I regard myself as a trend trader to some extent, and I think a lot of us here would regard ourselves as trend traders. You know, there's probably a million ways you can use to define a trend. and some might get you in a little earlier, and might some get you out a little earlier. But by and large, if the system is a real trend following system, I think we would all recognize a trend when we see it. So if Ichimoku suggests there's a trend, I think that the zone analysis should suggest that there's a trend there as well. And peak and trough analysis should suggest that there's a trend there. And moving average systems should suggest that there's a trend there. They just got slightly different timing elements to them. Ndumiso says that he's a swing trader. My system is fine, but I make losses. I think I need to line it with real expectations. And he hopes that I help him with that. Well, I think first, Ndumiso, let's go through this webinar. You've got to understand what that you're always going to make. You're always going to be susceptible to making some losses. We'll talk more about that in a moment, because I think I do have a solution to that. I think I do have a solution to that in these slides. Let's carry on, and let's go to the next one. Okay, now this is a big one for me. Consistency. Okay, consistency. How consistent are you in your approach to the market? How consistent are you to? Now you can see that there are themes that are starting to repeat themselves here. Remember the first slide, we spoke about moving from system A to system B, okay, to system C, to system D. Well, guess what that is? That's inconsistency, okay, because you're jumping amongst systems. You're not being consistent in your approach, and it's to your detriment, because each time you're jumping between systems, you are very likely moving from a system that's in its markdown phase into a second system that is maybe going into its markdown phase, into a third system which is going into its markdown phase. And all the time you're thinking, well, why am I not being successful? Why am I not being successful? And you're just not being consistent in your approach. Whereas if you're just stuck with one approach, eventually the markdown phase for that approach ends. It moves into its markup phase, and the trading account gets back to building. So consistency is a big thing, and it comes down also to what type of a trader have you defined yourself as. Have you defined yourself as a swing trader, and are you consistently using a swing trading approach? Because if you are a swing trader and your stop's is about to get triggered, and you move your stop lower, or you take your stop out, and you've now become in quotation marks, a positional trader, well, then you're not being consistent, are you? And in order to be successful in this game, you need to be consistent. Now, it doesn't mean you need to use one trading system. That's not what I'm saying. Let's say you've got 3 different trading systems. One is a swing approach, one is a positional trader approach, and let's just say the other one is a counter trend approach. Now, as long as you're being consistent in following the rules for each one of those, that's still consistency, right? But the idea is not to deviate one iota from what's required in each one of your trading approaches. Okay, so whatever system you choose, be it 1 or be it 2 or be it 3, it still means that you have to be consistent. It has to be consistent. Your approach has to be consistent. Nothing should change unless it's a tested change. Unless it's a tested change. Do you hear? Let's just see what Richard's written here. Okay, so Ichi is not necessarily the best indicator. However, it's good on the basics, identifying a trend direction, establish strict rules and where to place stop losses, and incorporates Gann, Fibs, and Elliott. A complete system can be made with Ichi, which imposes discipline if the system is obeyed without fail. If Ichi system is followed strictly, it eliminates emotion and bad habits of retail traders. Now listen to this very carefully. This is what Richard writes. If your system is followed strictly, now listen to the next part, it eliminates emotion. Eliminates emotion. Now, trading is, you know what the problem with trading is? It's emotional. It's emotional. We all are, as soon as we put on a trade, it's a roller coaster ride. We are putting money at risk hoping that we're going to come out with more. And when it starts moving against us, boy, do you feel it in the pit of your stomach, you know. And what Richard says, if you've got a system, yeah, so he's talking about the Ichimoku system. I would say with any system that you are comfortable with, well, if you follow it, it takes. I don't think the emotion is eliminated, but it's controlled, and but your bad habits are now eliminated. And Richard recommends again. I don't know this person, but Richard recommends Manish Patel's videos on YouTube. It's all free and no need to pay an educator to teach the system. Manish Patel, Manesh. I'll just repeat that: Manesh Patel, Patel. And I'll even go take a look there. Rich, I haven't looked at his videos in the past. Manish Patel. Now, we need to be consistent in our approach, okay? If we don't have the correct expectations and if we're not patient, guess what? We're going to be inconsistent in our approach. Because remember, correct expectations means that we understand that sometimes there's not going to be trade setups. Okay, if we don't have that expectation, well, then we're going to switch our approach. We'll have an inconsistent approach almost right away there. And the whole idea here is that all these slides that we're talking about right now, they actually all mesh into one another. They all mesh into one another because one mistake leads into another mistake, leads into another mistake. And if you start correcting one mistake, it leads into a correction of another mistake. So everything is very much related here. So we need to be consistent with the type of system we're using, consistent with the type of trader that we define ourselves as we are. And if we're just impatient and we don't wait for the setups, it's just going to lead to an inconsistent approach. By the way, patience is, there's another part of patience which I haven't put into these slides, which is equally as important. When we go into a trade and when we get a signal and the signal is hit and we pull the trigger and bang, we're in the market, we need to be patient for that to work out as well, right? Let the market do its thing. We've got to be comfortable enough to let the market really start moving in our favor. We want the market to see what we can see if we're right. If we're wrong, the stop loss takes us out, right? But we need to be patient enough to let the market recognize what it is that we already see. And we really have to plan for a string of losses, okay? Because the fact of the matter is we can easily make a string of losses. Even if you're using a very profitable system, it doesn't mean that you're going to be immune from one loss, and it certainly doesn't mean you're going to be immune from two losses in a row. And you could even have 3, 4, believe it or not, you can have 8 losses in a row. And you've got to understand that that's just part of your system's markdown phase, and you've got to be patient enough to accept that at some stage the market is going to realign with your system. If it's a trend following system, the market will realign with the trend following system when a trend reasserts. If the trend reasserts and you have a trend following system, it has to reassert, right? It becomes a lot more difficult if you are trading ranges. Once you're trading ranges, that is I found a very big challenge. And we don't want to hop between systems, okay? Hopping between systems, that's the beginner cycle. What you want to do is you want to find a system that you're comfortable with. And again, we'll talk about this in a slide coming up. You've got to find a system that resonates with you. Richard spoke about the Ichimoku, okay? Manish Patel. Go ahead, watch those videos, see if it gels with your type of personality. Choose a system that is comfortable for you. We'll talk about that in a moment as well. It's on one of the slides. Let's just see. I've got a few more comments here. Skulk says that he does make some good trades, and he's well up, and then suddenly he loses the trades. Okay, he makes some good trades, and then he's suddenly in some losing trades, and he's not sure what the reason is. But he thinks that when he's in the losing trades, he starts to chase trades and then he loses more. Yeah, it becomes almost self-fulfilling. It's self-inflicting and self-fulfilling. I think at that stage, Skulk, hopefully, this kind of, we all make those mistakes, by the way. Okay, we all chase trades. I'm going to talk about, believe it or not, revenge trading is a slide. Okay, we all embark on revenge trading. The idea here is to recognize what type of trader you are, recognize if that type of trading style fits with your particular psychology, have a system that is consistent with that type of trading style. Make sure that you're consistent in the way you are approaching the market with that trading system and that trading style, and expect, have realistic expectations. And then all of a sudden, you're looking at the market through a completely different lens. Richard writes, in swing trading, you need three things. You need risk control, you need a method, you need a way to identify the direction, and you need to know how to manage your trade and optimizing, and you need to know your levels to take gains out around the 80-90% mark. You can't have every pip. You can't have every pip. You've got to leave some on the table. If a true trend trader gets in as early as prudent and gets out near the exhaustion of a trend. So what Richard's saying, you'll never get in at the bottom and you'll never get out at the top. Well, that is exactly what trend trading is about. But if you capture the middle, well, that, you're going to have a fantastic time. Somebody said it this way. I once sent a tweet to one of our local commentators here, and I can't remember, it was on Twitter. He said something about trend trading. I said, well, we're never in at the bottom and we're never out at the top. So he wrote, yes, he says, but whilst we're at the party, we have the best time. Okay, so what he's trying to say is you still want the middle of the trend. That's our bread and butter. Skulk says your point number 3, Richard, is so true. Now, just to finish off Richard's point here, you can't have every pip. You've got to leave some on the table. Let me just see. If a true trend trader is getting in as early as prudent and getting out near exhaustion of trade, you can use the MACD diversion on standard settings to detect loss of momentum and possible turning points coming in the future. Okay, so Richard uses a divergence on the MACD. Eric says, hi Russ, can I get this material later? Now, I'll read this. So he says that he's going to be load shedded. So let me explain to our UK attendees what load shedding is. And it's probably why we're having all the problems with our power utility is now starting to cut out every once in a while. So Eric, yes, it's being recorded. Provided I don't have any load shedding on my side, you are more than welcome to send me an email and I'll send you the recording. Okay, let us continue. Let us continue. Okay, we must not chase the market, but we must also not chase systems. Okay, I think we have talked about that a fair amount of time, and we'll talk about it some more because there are some slides there. This is, Richard brought this up earlier, a trading plan. Okay, and I've said we've addressed this in a previous ad hoc webinar, and I do have, if anybody needs the link, it's recorded, you'll just send me an email. But the truth of the matter is that we all need a trading plan, but it's not a trading plan in our head, okay? That's not good enough. If we have a trading plan in our head, it's not concrete. Our trading plan must be written down. It must be written down. Now, it's a living document. Remember when I said you wanted to make a change to your system, it must be a tested change. Okay, once you've tested a change, you're happy with the change, you can alter the trading plan, but the change must be written down. It's important that you've got a document to refer to because it must be detailed enough that when you're looking at the market and you are confused and you don't know what exactly it is that you need to do, you need to have that trading plan that you can consult, and it should have the answer for you plain to see. Should I enter this market? Well, your entry conditions should be written down. Should I exit this market? Well, your exit conditions should be written down. Should I allocate X amount to this trade? Well, your risk management procedure should be written down. Okay, that trading plan needs to be detailed enough so that when you're confused in the market and you consult it, okay, you can come up with an answer that keeps you out of trouble. Now, the whole idea with having a trading plan, and this is very, very important, it makes you process oriented. It makes you process oriented. Remember when Richard suggested that you want to take your emotion out the market when you don't when you want to limit your mistakes? Well, that's having a plan. If you're going to use the Ichimoku, that Ichimoku needs to be written down on your trading plan so you can consult it. And all of a sudden, you now have a process that you can focus on, and you just follow your trading plan. Does it guarantee that you're not going to make a loss? Of course not. You will incur losses. That is part of trading. You have to be comfortable with that. Okay, it needs to be written down, not in your head. By the way, it's not good enough. When I first started, I knew exactly how I was going to trade. I knew exactly what my entry criteria was. I knew exactly what my exit criteria was until I cheated. Right? It's come down. Do I get in? Do I get out? Well, if I had a written down trading plan, I would have seen time for you to get out, Russ. And then instead of being a swing trader, I all of a sudden became a positional trader. So having a trading plan written down with all your methodologies, you want to be consistent, that's the way to be consistent. Now, if you follow the process, okay, if you follow the process, guess what the byproduct? The byproduct of following the process is results, right? So by being process oriented, you now indirectly are focusing on your results. I've got a few comments here. Let me just take a look through them. Okay, going back a few comments. Traders. Okay, Richard writes, a trader's best friend is the in the long term, on top of discipline, is getting stopped out. Okay, listen to that. So your best friend is actually to get stopped out. Richard writes, my biggest weakness was habitual revenge trading, upon which I was able to realize a new extended reversals and trend establishment strategy. I looked for multi-year highs and lows and then watched these to see when a trend comes in the opposite direction with an ATR based on trading stops. When I lose with this, I'm quite happy. Okay, you might, Rich, if you wanted, if you want to give us a sort of a lecture on that, let us know. No pressure, remember, no pressure, but I'd be really fascinated to see it. Okay, Skulk says, that's what I need, a trading plan for sure. And then Richard also writes, bear with me, do you have a recording of the Itchy presentation? Yeah, that is a good start. And then Manesh, which is a little more sophisticated. The only thing I don't agree with Manesh is is where he places a stop loss. I think it needs a lot more room than a couple of pips. Okay, and again, Richard refers to the ATR. The Ichimoku presentation, is that the presentation where Christian presented? Because I think that's the one that you're referring to. It would be, yeah, it would be somewhere. I'll need to find it. Yes, everything is recorded. I'm not sure which date it was. You see, that recording, I think that was part of one of our normal London webinars, I think. So I'll need to go back in my email, see if I can find a time or a date. But yeah, it would definitely be recorded. Okay. Remember that a good trading plan does not mean no losses. It does not mean no losses. In other words, it implies that there will be some losses, right? You can't get away from that. You can't get away from that. Okay. We'll talk about losses again. Remember this comment. Listen to this comment. A trader's best friend in the long run, in the long term, on top of discipline, is getting stopped out. Okay. That's your biggest defense against losses. You see, stop losses are actually a terrible thing. Now, before you get shocked, hear me out. Hear me out. Stop losses are a terrible thing. Why do I say they're a terrible thing? Because often your stop loss will get hit, and guess what? The trade then goes back in your direction. It happens to all of us, okay? But this is the truth. It's the lesser of the two evils. What's the second evil? The second evil is an uncontrolled loss. Okay, every big loss was at one stage a small loss. What a stop loss ensures is a small loss. So, yeah, I'm not a big fan of a stop loss. That doesn't matter. It's a non-negotiable part of your trading plan. It has to be in your trading plan. It's your only protection from a big loss. Okay, let's go on to our next slide. All right, I think this one is also a big one, and it's something that I also struggle with from time to time. And I usually struggle from it actually after I've taken a loss or a string of losses, is not pulling the trigger. This is not pulling the trigger, okay? So, look, remember, the whole idea here is not to be results driven, okay? Not directly. Of course, we all want to be profitable. I understand that, but focusing so much on the money, focusing on the results, in my opinion, is actually detrimental, because it makes trading a very emotional pastime or job. You know, it's really, and it makes it for a very stressful pastime or job, because you're focusing now on the cash. Okay, you're focusing on the cash. Okay, Shadrach, that's fantastic. Shadrach actually has given us the Ichimoku link. Fantastic. Much obliged, Shadrach. Thank you very much. So if anybody wants to watch the Ichimoku that Christian delivered, just send me an email, and I can, of course, pass that on as well. Now, the whole thing about not pulling the trigger, I think, is we are too much focused now on the results. Way too much focused on the results. But that's not what we have to do as traders. We must have a written trading plan that is now a process. We want to be process oriented. When we're sitting in front of the PC or the laptop or an Apple, and we are ready to trade, and all of our criteria as per our trading plan are met, that's the process. Okay, we should be pulling the trigger. Now, very often we don't do that. We don't pull the trigger. And again, I want to say that I've certainly been guilty of this. The reason that we don't pull the trigger is we're avoiding responsibility of taking a qualified trade. Okay, we're avoiding responsibility. Now, as a trader, you know, we've got to understand the business that we are participating in. Being a trader is difficult. Not everybody can do it. That's the truth. Being a trader is very difficult because of the emotion that goes behind trading, because of the discipline that's needed to be a trader. It's very counterintuitive to be a profitable trader. When you've got money on the table, how many of us want to close the trade? How many of us want to close the trade? When I'm in profit, I almost every single time I want to close a trade, it's a battle for me to keep it open. It's a battle for me, okay, because I'm going against my human instinct. What I'm looking to do is I'm trying to bank some money. But if I bank that when I have a profit on, I'm taking off the possibility of getting an even bigger profit in. It's very difficult. When we have a loss, how many of us battle to close a loss? A stop loss automatically does, okay, thank goodness. But how many of us actually battle and even think about moving the stop loss down? It happens to me every single time I trade. It's because I am almost convinced that I'm right and the market's wrong. So human intuition, our emotions, get in the way. And because of that, we are avoiding responsibility of taking a qualified trade. We must recognize as traders that uncertainty is just a part of the deal, okay? Every trade is going to be uncertain. If you put in on any trade, the potential for you to make a profit is uncertain. Okay, the potential for you to make a loss is uncertain. You don't know how it's going to turn out. Okay, what is a certainty though is the process. So again, I want to stress focusing on the process, not on the results. You know, at the end of a quarter or at the end of the week or at the end of the month or at the end of the year, sit down, take a look at your equity curve and see how it's going, but not when you're in the trade. When you're in the trade, the money is irrelevant. The process is important. Okay, if you follow the process should win out over time. It doesn't mean that you won't have a loss, on that particular trade, that trade is uncertain. But if you're trading a good system, okay, if you're trading a good system over time, it should be putting money in to your account. Remember, we talked about positive expectancy. We've talked about positive expectancy many times, where expectancy is the business that does it the best is a casino. They're running a positive expectancy business. Do they make money every single night? And I would suggest that no, they don't. I would say that sometimes they pay out quite a lot of money, but over time, the casino knows, the statisticians know, we all know that the casino is going to be making money. Okay, that's because they're just following the process. They're not looking at the money. Okay, they're following the process. Let's go on to our next slide. I think this one is very, very important. Too much leverage, okay? And we all know that leverage is a double-edged sword, but we're all addicted to it. We're all addicted to the leverage. And the reason that we're addicted to the leverage is really comes down to that get-rich-quick mindset. That get-rich-quick mindset. And it's so pervasive, this get-rich-quick mindset. I'm not sure how many of you ever heard of that. I'm not sure if it was a pyramid scheme, what it was. It was called Triple M. Did any of you hear of Triple M? I'm not sure how big it was in the UK. It was pretty big down here. Apparently, I think it came out of Russia, but it was a scam when you had to put money into somebody else's account. And I mean, you could see it from a mile away. You could see it from a mile away. And the amount of people that were caught by it was there's only one reason for it: get rich quick, okay, get rich quick. So that's exactly what leverage is get rich quick. But it's a double-edged sword, okay? It's a double-edged sword. Your profits are going to be enormous with leverage, considering the amount of trading capital you have in your account, compared to how much you can pull out of the market because of leverage. Okay, it makes leverage very, very attractive. But we all must recognize that not only will your profits be larger, your losses are going to be larger. Okay, so if you take on too much leverage, and you hit a loss, okay, it's going to take a chunk out of your trading capital. Now, the question is, well, what's the difference if profits will be lost and if profits are large and losses are large? Surely they net off with one another. If that's what you're thinking, it's not correct. Okay, mathematically, your losses are going to hurt more. We have, I think, discussed this in our trading plan webinar. I think it was that one. But a 10% loss, okay, is not offset by a 10% gain. Think about it this way: you got $100, you lose 10%, brings you to $90. Okay, you're sitting on $90, you make 10%. That's only $9, right? So from $100, you're now sitting on $99. So you're still $1 short from break even. A 10% gain does not offset a 10% loss. It gets worse, okay? If you lose 20%, so you now take your $100, you go down to 80, you've lost 20%. Okay, how much do you need to break even? You need $20. You need $20 from your 80. Percentage-wise, that's 25%. So in order to break even from a 20% loss, you need to make a 25% gain, and that makes you break even. And it gets worse as you lose more. If you lose 50%, you need 100% just to break even. The mathematics are terrible when it comes to losses. And if you are over leveraging, your losses are going to hurt. That is just the mathematics of leverage. And at some stage, it's going to hurt your account. It's going to hurt your account. So the way that we trade is we trade like professionals. We understand that it's a lucrative market. But as a lucrative market, it also means that it's not a get-rich-quick market. Sure, there are some traders that have done that, and best to them. It's not the norm. It's not the norm. You sit down and you let the power of compounding do its thing. And then one day you're going to look at your trading account and you're going to think, wow, where did all this money come from? But it's only going to happen if you respect risk, you respect what leverage can do to your account if you're on the wrong side, and you let time do its thing with regards to compounding. Okay, so it's very, very important to acknowledge that. Remember that once you put on a trade, okay, it's out of your hands. You don't know if you're going to take a profit. You don't know if you're going to take a loss. It's now out of your hands. You've put on the trade, and all you've done is you've looked at your trading plan. It's met all your criteria. You've put on the trade, okay, but the outcome is now out of your hands. The market is going to do what the market is going to do. So if the outcome is so uncertain, what's the point of trading? What's the point of trading? Because not everything is out of your control. As a trader, you do still retain elements of control. Where is that? Any idea where that element of control is? Go ahead and type those through. Let's just see. Richard says, was it in September? It was a good place to start learning Ichimoku or trend strategies in general. Problem lately is a conflict in the USD index and trends. Yeah, email me, Richard. Absolutely, email me. Yeah, no worries. All right. So the question is, if the trade is uncertain, if it's out of your hands, what can you control? What is it that's still in your hands as a trader? What can you control? Anna Maria says the process. 100% the process. Let's be even more specific. Inside the process, what is it that you can control? Anna Maria says emotion. I think the emotion's tough to control. Michael says the stop loss. Shadrach says the size of the trade. Well, that's exactly what I've got here. Money management is in your control. The money management's in your control. Okay? If you are not even controlling your money management, you're leaving everything to chance. Okay? The money management's fully in your control. 100%. Aline, okay, no worries. Thanks for joining us. As I said, is recorded. The process controls emotion. That's what Anna Maria says. Yeah. Okay. Richard writes, one's plan, yeah, and the risk limit, yeah, except when there's gapping. Okay, yeah. But even if there's gapping, Rich, it's still going to take you out at the closest price. Now, it could be enormous slippage. It could be enormous slippage, but there is a modicum of control that you exert. Words of wisdom here. Richard writes, we are risk managers, nothing more. Need better than a risk to reward of 1-to-1. Okay, let's carry on, because guess what? That is in the slides. Now, let's just talk about the next point, that mistakes that we do make as traders, and that is revenge trading. Revenge trading. Okay, so over time, and it's going to take some time to figure this out, but over time we've got a rough win percentage. So we'll know perhaps 50% of the time we win, 50% of the time we lose, but we understand that whatever system we're using, maybe it's a 60% win percentage, but as traders we understand that there is a certain amount of trades that we'll take that are actually going to be losses. And again, in one of the earlier slides, we said we've got to be comfortable with that. If we're comfortable with that, then we accept it as a business cost. But if we're uncomfortable with that, then what we can do is when we take a loss, we start revenge trading. In other words, as soon as we take the loss, we close that trade, we start looking around for another entry, even if it doesn't meet any of our conditions as per our methodology. All of a sudden, we in our heads see a possibility, boom, we put on another position and we start revenge trading just to get back what we've just lost. Who's done that before? My hand's up, just by the way. Has anybody else done that? Revenge trade. Anyone revenge trade? Paresh says all the time. Lee says he has. So Richard says, I've wasted a huge amount of cash and time on revenge trading. Okay, Skulk, he does that. Michael says, done it and lost profit, my taste. Yes. Well, that's my, how many times does it work out? You know, sometimes it does, sometimes it doesn't. But when it doesn't, it usually hurts very, very much. And it's usually a bad loss. Now, this is what we've got to understand about revenge trading. Okay, listen to this very carefully. Trades are independent of one another. The trade I put on now is independent of the trade I put on this morning. Okay. The trades that we put on are completely independent to one another. Now, it's a hard concept to grasp because, again, well, if trades are independent from one another, what's the point of trading? Well, the point of trading is that over time, okay, you still want to be working a positive expectancy system. Over time, positive expectancy starts building into your trades, but it only builds into your trades over time. In the short term, each trade is independent. You're not guaranteed to make a profit after a loss. You're simply not. Okay, think about it this way. Think of a coin toss. Okay, if we are flipping a coin and we're choosing heads or tails, okay, what do we expect over a thousand coin flips? What do we expect? We expect roughly a 50-50 distribution, roughly, right? Over when we have a large number of trades, we expect 50-50, right? But if I do a coin toss now and it comes back heads, and I pick it up and I do another coin toss, is it going to come up tails? That's the question. Is it going to come up tails? So my first one's head, and I do a second, is it going to come up tails? And the answer to that is, well, it might. There's a 50-50 chance, right? There's a 50-50 chance, but the point is it can still come up heads. Over time, the odds will start playing themselves out. The probabilities, I beg your pardon, will start playing themselves out. Same with our trading. Over time, the probabilities are going to play out. Each trade is going to be independent, though. It's a very difficult concept to grasp. But the point is that if we revenge trading, it's as good as a coin flip. Okay, it's as good as tossing a coin and flipping a coin. You might get your money back, you might not. All right, so for revenge trading, I promise you, is certainly something that if you're doing it, you've got to try and stop yourself. And I promise you, I've done it before myself. Traders as a whole would be susceptible to this. The reason for this is that trading is uncertain. Okay, every trade is unique and it's uncertain. The only thing that we can control, is our risk management. We can, of course, if we can control whether we want to go in or not by following our entry parameters and our exit parameters. But truly, once the trade's on, we're uncertain whether we're going to make a profit or a loss. It's completely uncertain. The only thing is certain is if we make a loss, how much we're going to lose. It's a controlled loss. That's the only control we have. It's the only control we have. Okay, you've got no control over whether you're going to make a loss or a profit. But if you're working a positive expectancy system, over time you will make a profit. Each trade, one after the other, though, is independent. Does that make sense to you guys? It's a very, very difficult concept. If anybody is not sure of that, just type in N. If anybody's not sure, type in N. Okay. Okay, I think everyone is on top of it. All right. The only way to deal with uncertainty is risk management. In other words, you know how much you are prepared to lose. It's a controlled loss. It's a controlled loss. Something we mentioned earlier, which I want to put in, is of course starting capital, because and again I think this is very much a And you know, subject to correction. And excuse me if I'm not correct here, but I think it really plagues traders in South Africa, in that traders come with a smaller amount of capital expecting to make a large amount, and it's not true. You know, your returns will be proportional to your starting capital. It doesn't mean that you can't trade. It just means that you must have realistic expectations. Okay, remember, you can still make percentage-wise a good amount on a smaller capital as long as you are using risk management, and as long as you have realistic expectations. You can still, on your trading capital, you can still do relatively well here. But of course, smaller accounts will be more restricted. Okay, they will be more restricted. It doesn't matter what your account size is. Risk management is, of course, essential. Now, remember, I said a stop loss is not ideal. Nobody wants to have their stop loss hit, but there's no other choice. You have to have a stop loss. It's the lesser of the two evils. Expectations must be realistic with a smaller account size. Let's take a look at risk management. Now, this is huge. Okay, this is huge. Now, I can tell you the number one reason that accounts blow up. You can read it right here. It's because of a lack of risk management. Why is there a lack of risk management? It's because of the get rich quick mindset. The get rich quick mindset. So you can see how everything's starting to link together. You see how everything's starting to link together. If you can fix one up, it's like a ripple effect. It will start improving all these different mistakes. If you make one mistake, it ripples out and affects other areas. So I know discipline is so essential, but it's so difficult when it comes to this type of a business. But what we have to recognize is that if we do not have risk management, at some stage, you're going to do some real damage to your account. I would put money on it. I'm afraid to say that if somebody comes to the to trading and they're not using risk management, at some stage you're going to do some real damage to your account. And once you've done damage to your account, it's impossible, almost impossible to come back, and sometimes impossible to come back. Sometimes you need to just cut your losses and recognize that you are wrong. And the only way to do that is to use risk management. Now, what does risk management mean? Well, the textbooks say that you should use 2% risk per trade cumulatively. That means if you've got two trades on, each trade should have 1% risk to your trading account. Okay, and it's actually 2% is it's actually very high. Okay, if you can put in less than 2%, that 1%, max for 1.5%, it's better. Trust me, it's better. The reason we don't want to risk 2%, the reason we want to not have 1% or 1.5% or even 2%, again, is the get rich quick mindset. We're thinking that we've got too small a position for us to make some real money out of this. And you might be right. The truth of the matter is that if you are trading, you should be trading as professionally as possible. And if you are taking 2%, it's very, very high. Okay, it's very, very high. If you can do less, you should do less, and understand that over time, compounding will take care of everything. Okay, because if you're taking a 1% trade and you start growing that trading account, that 1% in effect starts growing with your account. Okay, but percentage-wise, your risk remains consistent or constant. So the idea is, you know, we really have to embrace risk management. It's one of the biggest mistakes that we make as traders, and it's the number one reason why we're going to blow up an account. Richard says, real damage will lose all your money in the account and be closed out by your broker. Matei says 2% is way too high. Richard says, FXCM forcibly closed down all my trades due to habitual revenge trading, and I lost all my positions as well as a great deal of cash. That's hectic. Yeah, but I think that the reasons for that, you would recognize a lot of those in today's presentation, wouldn't you, Richard? You've just said revenge trading, right? And all of these things, it's like a spiral. Once you start making these mistakes, revenge trading, you stop taking risk management precautions, and it just they start building on each other. That eventually you've just done irreparable damage to your account. So these things that we're talking about here can have a real impact if you just manage to get some sort of control over them. And as we've mentioned earlier, risk management is a controllable variable, and it's ignored, okay, because of that get rich quick mentality. Now, this is what Richard wrote earlier. Don't be the best trader, be the best risk manager, which, funnily enough, generally leads to good trading. So don't try and be the best trader. Try and be the best risk manager. When you're writing out your trading plan, okay, pay particular attention to the risk management part of your trading plan. Put a lot of emphasis on it. Okay, risk management, by the way, doesn't mean that you just willy-nilly close out a position because you think that it's getting too risky. That's not correct risk management. Correct risk management is understanding that you've got a stop loss. It's the minimum you're prepared to lose. It means that when you are at a certain point, it's worthwhile putting your stop loss up and start trailing it. Okay, that's part of good trading. But it's all about being a good risk manager. You be a good risk manager. One of the benefits of being a good risk manager is that you start trading well. Alrighty. The next part is the search for the Holy Grail. Okay, it's called Holy Grail trading. It's also known as system chasing. It's also known as system chasing. So we're going to talk about this for a few slides. I think this slide and the next. And this is exactly what we've mentioned earlier. You need to find a system that makes sense to you. So if it's Ichimoku, then it's Ichimoku. It has to make sense to you. But then you need to change it to reflect your style and personality. Now, when I say change it, it's got to reflect your preferences in terms of what kind of a trader are you? Are you a scalper? Are you a positional trader? Are you a swing trader? It might be a zone analysis. It might be a moving average system. It needs to make sense to you. Some people look at moving averages and it gives them shivers down their spine. That's fine. Then it does not. Then you just simply not use that. You do not use that system. You use a system that is completely comfortable with your personality as a trader. Matthijs says here that the Holy Grail doesn't exist, and it doesn't. I've been trading since the late 90s. Okay, I've been trying my hardest. At least in the first few years, I've been trying to find the 100% system, and it just doesn't exist. Doesn't exist. You can't escape losses. Okay, can't escape losses, and you at some stage as a trader, you've actually got to just be comfortable with the style that you choose. You can't jump from system A to system B to system C. We've talked about consistency. Okay, you just got to understand that some of these sometimes your particular style of trading is going to hit a markdown phase. It's not just you. Every single system that you choose is going to have a markdown phase in it. You can't win every single trade. Every single trade is uncertain, except over the long term. Sometimes you're going to have to be comfortable with the approach that you take, and there may be better approaches, but there's also a lot worse approaches. As long as it reflects your trading personality, as long as it reflects a trading plan that's written down, as long as it's got a positive expectancy, that's all you can do as a trader. Yes, it's a living document. You can make adjustments to it as long as they are tested adjustments. But you really want to be happy with the approach that you settle on. Focus on your risk management and your trading psychology. Okay, and I think having risk management does a lot for trading psychology. And then again, I've got here: be process oriented rather than outcome driven. The byproduct of having a good process is, of course, your outcome will be adequate. Okay, Richard writes, let's just see here. Okay, Michael writes, in positional trading, in positional trading, can a system be incorporated into a following system? Just expand that out, Michael. I just don't quite have the question. Just write that for me. Richard writes, I let the emotions devil take over and many times ditched my expensively acquired trading education and the hard for me to implement emotionally rules of discipline of risk management. And so what Richard's saying there is emotion. Okay, emotion has been his undoing many, many times. Michael, is positional trading? Positional trading is trend following, if that makes sense. If that's what you're asking, Michael, I'll keep a lookout for that. Let's just look at the next slide. Okay, focusing on the win percentage. It is better to focus on your reward to risk than your win percentage. Focusing on the win percentage is looking for a 100% system. And as I've said before, that system doesn't exist, and it's linked to searching for the holy grail. So just to unpack that, I think the first line there, reward to risk ratio, is very important. If you can make a decent reward to risk, and if you assess your entries according to risk to reward, I think you are approaching the market in a very, very admirable way. So you want to understand, like we looked at the DAX this morning. Now the DAX has broken out of a flag pattern. It looks really, really good. But when we looked at the hour and we looked at the 4-hour chart, they were sitting in heavy overbought systems. So the risk to reward looked a bit skewed there. Now, risk to reward also means if you are willing to risk, say, 10 pips, you've got to make sure that the reward is generally in excess of 10 pips. And if your reward is in excess of 10 pips and you're trading a 50-50 system, you automatically become profitable. But the idea here is that focusing on the win percentage is really like chasing a system. You have to at some stage you have to be comfortable with your system. You have to make a conscious decision that, okay, this is the system that I'm going to use. You're going to have to be happy with that decision, and the idea then is not to focus so much on the win percentage, but on the reward that the system can give you relative to the risk. Richard, thank you. So Richard says the Holy Grail slide is spot on. Yeah, I think so. Yeah, because I've looked for that Holy Grail all my life. I've never found it. Guys, I want to reiterate again. In your trading, you will have losing trades, and this must simply be accepted. There's no such thing as that 100% win system. No such thing. You have to be... taking a loss is a business cost in this business. It's a business cost. If you aren't able to take a loss, and the reasons for that, by the way, people aren't able to take a loss in the market because they can't accept that they are wrong. It's happened to me plenty. As human beings, we don't like to be told we're wrong. The market forces us into the fact that it forces us to face the fact that we are wrong, and we don't want to face that fact, and we don't take the loss, and that's a big mistake. It's one of the mistakes we make. That's why we start playing around with our stop losses, shifting them down, taking them out. The truth of the matter is, just think about a loss as a business cost. Any business that you start is going to have costs associated with it. In our business, it's a trading loss. It just has to be a controlled trading loss. If it's not controlled, okay, that means that from being a small loss, it's going to grow into a big loss, and boy, oh boy, is that going to hurt. Let's take a look at the next one, which is over trading. I am cognizant of time. I know we've been going a long time, guys. I think we're pretty close to the end. It's you guys good to go? I did schedule this for 1.5. We may go a little bit more than 1.5. Michael writes, let's say you start out with a position trade, a trend, and the trade runs your way. You switch to a longer time scale system, which allows for retracements, which would be contrary to the original trend, but following the longer term trend. Let me think about this. I'm not sure if that would be optimal, Michael. I think that the idea here is if you're following a trend trading system, the idea is that you should be able to trail your stop loss up depending on your time scale. Okay, whether you're a swing trader or a positional trader, the in my opinion, and if you aren't happy with this, email me. But my opinion is that the trailing stop should at some stage take you out. And if it takes you out when there is a dip and then the trend reasserts itself, I would suggest that maybe getting in the second time as the trend reasserts itself and just being consistent with your approach. The reason why I'm a little worried about changing the style is it develops bad habits. It develops bad habits. So it might work out once, it might work out twice, but when it doesn't work out, again, it's going to hurt the account. So I think that's the way to approach it, just to be consistent. Guys, listen to this, okay? Because we all fight this. We don't have to trade every day. I love trading. I love it, and I want to be in positions. But the truth of the matter is, if there's no entry, we shouldn't take a trade. Okay, we don't want to chase the market. We want the market to come to us, and we don't have to trade every day to be profitable. We want to look for our quality trade setups as per our written down plan, and we want to try our best to not revenge trade, because hitting a stop loss, if it's according to our plan, instead of revenge trading, you should pat yourself on the back because your trading plan has worked out. Okay, if you are stopped out of a trade as per your written down trading plan, that's a good thing. Okay, we don't want to chase trades. Okay, we want to resist. All we want to do is we want to focus on the process. If you focus on the process, okay, not focus on the outcome is a automatic byproduct. Automatic byproduct. Now, one of the hardest things for us is to accept responsibility. Okay, sometimes we'll buy a system, and the system, we're not profitable with it, and we blame the system, we blame the vendor, and that's not really the way to go. If we are deciding to become traders, okay, we have to accept the responsibility of being a trader that's going to grow and look after our own money. Nobody's going to look after our money as well as we are. Okay, assuming we're doing it professionally. Okay, assuming we're doing it professionally. When I say professionally, written down trading plan, entry requirements, exit requirements, stop loss requirements, risk management requirements, market requirements, written down. But the truth of the matter is we have to accept responsibility. And that also means using a system that makes sense to us, but then we make it our own. Okay, every single one of us has our own psychology. We're all comfortable with different things. What's normal for us, what's normal for me might not be comfortable for somebody else. And what's comfortable for that person might not be comfortable for me. The way I trade's got to be right for me. The way that person trades has got to be right for that person. We can't, if you give somebody, if you have a room of 100 people, you give somebody the same system, I promise you, you meet back in 30 days, you've got a room full of people that each has their own unique system. In other words, one system has now become 100. Okay, everyone's turned their one system into their own, and that's good. Okay, because it means that the system's now starting to align with their trading psychology. Okay, so we're all going to have our unique style, but the thing is, if we all have our own unique style, then we all have to be responsible for our own trading, because we're all going to trade very differently. Nobody else can can tell you how to trade. If it's not right for you, it's not right for you. So you really have to own that. Okay, nobody else will make the money for you in this business in terms of retail trading. It's really your responsibility. It's our responsibility. All right, Anna Maria, thanks very much. We're getting pretty close to the end. Thank you very much. If you want the link, just email me. Richard writes, in trend trading, it is okay to get in with a breakout. Even better if a breakout comes after retracement to, say, a fib level or to an itchy level, and it is done in a lower time frame, which is encouraged also by a continuation diversion signal on the lower trade entry time frame, or perhaps, but less likely, on the higher time frame, like the daily time frame. So as I understand that, Richard, you're saying if you stopped out, you can re-enter. Do I understand you correctly? If you get stopped out and then the system gives you an entry signal again, you can get back into it. Just waiting. I'll just move on. I'll wait for that. Yeah, okay. Okay, got you. Let me go through to the next slide. Guys, thinking we have control. Once a trade is made, we have no control on the outcome. We're either going to make a profit or we're going to make a loss. Those are the two outcomes, and we have no control over which one it's going to be. Okay, and it's terribly hard to accept this. It's very hard to accept this. I've actually read that it is very skilled professionals that have the hardest time when it comes to trading, because those particular professionals are so good in their environment. They have almost complete control in how things turn out in their professional environment, that they're so used to that when they come to trading, that lack of control is a big problem for these people, because they're not used to it. But the truth is that we have no control. The only thing we have control over is money management. And because it's the only thing that we have control over, it needs to occupy a lot of our thinking regarding trades. Okay, it has to be a major part of our trading plan. It has to be a major part. And of course, we have to know that it's quite possible for us not to make one loss, not to make two losses. We can make a string of losses, and it's okay. It's okay as long as it's controlled losses. I think this may be the last slide or the second last. So we need to know also when to take a break. Okay, we can't trade continuously. I mean, today is this is my last day of 2019. I'm back on the 6th of January. I don't want to look at the markets for the next 3 weeks. I don't. Well, I do. I do, but I'm not gonna, because I just need a break from it. I just need to come back with a fresh mindset. I need to start 2020 with new insight. I need to have fresh eyes. I want to rethink things, see what the fundamentals and the technicals are looking at. I need a break. I need a break. Okay, so we all need to know that it's okay to take a time out. And not only that, okay, not only that, we shouldn't trade when we're not in the right frame of mind. The truth is, we need to be in the moment when we're trading. When we are doing our non-farm payroll trades, often I'll go silent while we're doing the non-farm, because I'm trying to be in the moment. I'm trying to see what the market's doing. Now, I'm not always able to align myself with what the market's doing, but I'm trying to be as present as possible. Now, if I don't have the right mindset, it's going to be exceptionally difficult to do that, because we have to be in the moment. Okay, so we need to take a break when we recognize we don't have a positive mindset, or if we burnt out, we should take a break and go for a walk, get some sort of exercise. And life is life. Sometimes we are tired, sometimes we get angry, sometimes we're upset. Guess what? You don't have to trade then. You're not in the right frame of mind. Take a break. It's not the end of the world. The market's going to be there tomorrow. It's going to be there next week. It's going to be there when I'm back on the 6th of January. Okay, when we're trading, it's one of the toughest pastimes, because we have absolutely no control once that trade is taken. Okay, we have to be in the moment. Simple. If you need a break, take the break. Let's just see. Matei says this webinar is is the best summary of a trader I've ever come across, and is a summary of my 20 years of trading and learning process. Every word in this webinar is 100% the truth. Well, thank you very much, Matei. As I say, if you need it, it is being recorded. Just email me for the link. Michael says, thank you for this useful webinar, very informative. Thank you, Michael. And I want to just thank all you guys as well, because this does bring us to the end. So we've gone for an hour and 35. I hope that you guys found it useful. And let me tell you that no one's immune from this. The pros, the guys that do this on a fund management level, aren't immune to this kind of stuff. Okay, it's I think the first step is the awareness, and we're always going to make mistakes. As long as we can realize we're making the mistake, I think that's the best that we can do. All righty, guys. Any final questions? Go ahead and type those through. Any final questions? Go ahead and type those through. We do have one more webinar. It's at 4:30. It's going to be very short. Just after these ad hocs, I'm very tired. But we'll take a look at the weekly charts. I think we'll do the weekly charts. If I don't speak to you in an hour's time, I just want to wish everyone a very Merry Christmas and a festive season, and however you guys sort of um, uh, celebrate this at the end of the year, or if you take time off, just have a wonderful time. And of course, then we will catch up on the 6th of January and start 2020 off with a bang. All right, Skulk, excellent. Well, I don't see any other questions coming through, so join me in about an hour's time or so. Otherwise, we'll look forward to speaking with you again in the new year. Thank you very much, Lee. Thank you very much. Thanks, Shadrach. Thank you very much, sir. Thank you very much for that kind email yesterday, Shadrach. Very appreciated. Very much appreciated. All right, guys. I'm going to drop off now. Thank you so much for your time. If anybody needs a recording of this, just shoot me an email and I'll send it through to you. Thank you very much, everyone. And either speak to you soon or in the new year.